Hello and welcome to SSG Wealth Daily Wealth Insights. If you're new to this channel, do subscribe to the channel because we keep on bringing wealth insights for HNIs and NRIs across the world on a daily basis that really helps you to optimize your portfolio. So today's title is Why Central Banks and Top 1% of Investors Are Hoarding Bullion in 2026. So, if you are an NRI or a business owner managing portfolio of more than 1 crore, you have likely watched gold prices absolutely explode over the last 14 months. As of February 2026, gold has shattered $5,200 per ounce mark globally. On the Indian MCX, we have seen prices touch a staggering high of 1.6 to 1.7 lakhs per 10 grams. In 2025 alone, gold delivered a historic return, rising anywhere between 40% to 70% depending on the currency of that particular country. And retail investors think it is a bubble, but institutional money knows exactly what is happening. I am an ex SEBI registered research analyst from 2020 to 2025. Post surrendering my SEBI registered research license, I have founded SSG Wealth to help you invest in the right manner in multiple financial products like mutual funds, PMS, AIF, SIF, and fractional real estate projects. Today, I'm going to pull back the curtain and show you exactly why gold is rising, who is actually buying it, and how family offices are positioning their portfolios for the $5,600 target later this year, and what is the long term game in gold. To understand the price, you have to understand the buyer. Who is buying so much gold? See, the current rally is not being driven by retail jewelry demand. It is being driven by structural geopolitical panic. Global central banks, specific in emerging markets like India, China, and Poland, are aggressively diversifying their reserves away from the US dollar. Consensus estimates show central banks will purchase around 800 tons of gold in 2026 alone. But it's not just governments, private institutional money is flooding the market. For example, the crypto giant Tether has quietly accumulated roughly 148 tons of gold valued at over $23 billion, making it a larger buyer than almost every nation on earth except for a valued at over $23 billion, making it a large buyer almost every other nation on earth except for a select few nations. When private entities start buying gold like sovereign nations, you are witnessing a fundamental shift in global trust. So this is the institutional anomaly. Private capital acting like sovereign states. Tether buying $23 billion of gold, almost 148 tons till now. And if you see the ranking, they are buying more gold than almost any nation on earth except a few selected large nations. And the signal here that is giving to the global markets is when private liquidity giants accumulate physical assets at this scale, it marks a fundamental shift in global trust. And now let's understand the 2026 catalyst, tariff and the flight to safety. Why did gold suddenly spike near 3% in a single session this February? Because of trade wars. The recent implementation of a 15% global tariff by the US administration triggered an immediate flight to safety. We saw the Dow Jones crash by 800 points in a single day as an institutional money rotated out of equities and directly into safe haven assets. Furthermore, industrial metals tied to economic growth like copper and platinum actually fell, while safe haven metals like gold and silver skyrocketed. Smart money is actively pricing in global trade friction and slowing economic growth. Does this give a sign of global recession? If you see over here, Dow Jones has fallen by 800 points in single day and gold has gone up by 3% in a single session. So this is all because of the implementation of the 15% global tariffs that the US government has levied. And the analysis here is that smart money is pricing trade friction rotation out of equities is going, the cash flow is moving out of equities and it is going into sovereign grade collateral, which is essentially precious metals. Beyond geopolitics, there is a cold mathematical reason for gold's rise, and that is interest rates. The US Federal Reserve has shifted its monetary policy, cutting rates by 25 basis points in late 2025 to maintain liquidity. Historically, gold has an inverse relationship with real interest rates because gold does not pay a dividend or yield interest. Because gold does not pay a dividend or yield interest, it becomes mathematically much more attractive to hold gold when central banks lower the interest rate on cash and government bonds. So hence this diagram shows that when the interest rates are lowered as Fed cut in 2025, late 2025, there becomes a lower opportunity for buying gold bonds or to keep cash. And this is there because this diagram shows you very clearly how when the interest rates are lower, the opportunity cost is reduced and gold's superiority increases and hence results into gold prices inflation. So here the main insight is that gold does not pay a dividend, but when the yield on cash drops, the penalty for gold holding disappears. Now let's look at the most conservative forecast for gold. Goldman Sachs has targeted $5,400 by end of 2026, but this is a very conservative number. Many research firms say that gold can touch almost $7,000 by end of 2026 and almost touch $15,000. Yes, $15,000, that is three times from the current prices by the year 2028. So, where is this all going? Tier 1 institutions like Goldman Sachs have officially raised their base case target to $5,400 per ounce by the end of 2026. But here is where HNIs can make a critical mistake. When wealthy investors hear this, they go out and buy physical gold bars. That is a trap if you do it in India. You instantly lose 3% to GST, plus making charges, plus bank locker storage fees. Institutional investors and family offices do not buy physical gold. They allocate through RBI sovereign gold bonds or through gold funds or gold fund of funds. And especially in the sovereign gold bonds, you earn 2.5% extra income on top of the gold price appreciation per year. And this seamlessly hedges their equity portfolios against market crashes. So as you can see over here, this is the retail trap, inefficiency of physical gold ownership, and why you should avoid physical bars and jewelry. So the wealth leak over here happens instantly because when you buy physical gold, you have to pay 3% GST immediately. On top of it, you have to pay making charges, which is a complete sunk cost. Then you have to pay storage fees to store it in some kind of a locker facility. And then there is liquidity friction because exit becomes very difficult to sell. Gold bars becomes very difficult, and that is a big challenge. So the verdict here is that wealthy investors and HNIs buying physical bars are voluntarily accepting immediate capital erosion, which means that if you go ahead and buy physical bars of all the capital allocation that you have, you might have say 0.5% or 1% of your portfolio in physical gold bars just as absolute safety. That's a different scenario. But keeping 15-20% of your portfolio in physical bars does not make sense at all in India. So, if your portfolio is completely exposed to public equities or worse, if you are a business owner leaving crores sitting in 0% current account while inflation and currency debasement eat your purchasing power, you are bleeding wealth every single day. At SSG Wealth, we build institutional grade portfolios for business owners, NRIs, and high earning professionals. We don't just buy mutual funds, we architect your capital using alternative investment funds, portfolio management services, and other financial assets. That also includes structured credit and precise macro hedges like gold funds. Click the link in the description to apply for a free business treasury audit or free personal portfolio audit. Let's look at your exact asset allocation and properly institutionalize your wealth for 2026 and beyond so that you continue to grow your wealth and create generational wealth for you and your family. Subscribe SSG Wealth for more such financial and wealth insights. This is what we help our clients to achieve, that is portfolio architecture, and we look beyond simple allocation. If you are a business owner, then you might be in this danger zone where you are holding crores of rupees at 0% current accounts, or you must be having 100% exposure to public equities. The result is that you are bleeding wealth via inflation and currency debasement on every single day. The SSG Wealth approach is that we help you to create institutional grade portfolios for NRIs, high earning professionals, and business founders. We help to architect your wealth and your portfolio through AIFs, we help you to architect your portfolio through various financial products like mutual funds, portfolio management services, AIFs, and fractional real estate investing. And this is why we say that we don't just buy funds, we are capital architects. We help you to architect your entire portfolio. So, do book your free business treasury audit. Re- so, do so, click the link in the description and book your free business treasury audit review or your personal portfolio review with SSG Wealth. This is absolutely free. You don't have to charge. This is absolutely free and you don't have to pay anything for the service. Also, if you like this video and for more such wealth insights, subscribe to SSG Wealth and like this video if you found this information useful. Share it with someone who can benefit from this information and share your thoughts in the comment section below as well. We would like to read them as well. And also hit the bell icon so that on a daily basis you will be notified whenever we will upload a new wealth insight video at SSG Wealth. Thank you so much for giving your time. Have a great day. Goodbye.